slides here to go through on pitfalls that we see in business valuation and things to keep in mind when an appraiser is valuing a healthcare business. Just kind of general issues to start. I had alluded to earlier, many general appraisers or non-healthcare focused appraisers are typically focused on a couple of different matter types. It may not be an industry type they're focused on, but they may be focusing on gift and estate, financial, fair value matters for financial reporting. They could also focus on ongoing ESOP valuations, things that are very distinct. Here, many times, Fred and I and many others who focus on healthcare valuation, we're hired to provide initial opinions prior to a transaction being conducted. So we're regularly relied on by our clients to perform an initial level of due diligence. So our client is the buyer, and we're working very closely with the potential seller. So again, that's an area where you have to just be mindful of the information that's coming through. Regularly, the evaluator may be more knowledgeable about the business than the buyer of that business, given that the buyer's waiting for a valuation opinion as well as some help with some initial diligence from a valuation firm or other consulting firms. General issues that we run into, standard of value. As I mentioned, we encounter situations in which folks who do not focus on healthcare valuation get involved in healthcare related transactions, and sometimes they forget that there are differences between the standard definition of fair market value and the healthcare specific definition of fair market value, or they're focused, the generalist is focused their practice mainly on fair value for financial reporting matters. So it could be a purchase price allocation, and they're able to maybe consider aggressive adjustments to a pro forma based on the definition of what a market participant may do with a particular business or may be able to achieve with a particular business. There's certainly cases in which, and we'll talk about those in the next slide, in which it's appropriate to adjust a pro forma, but just have to be mindful if we're adjusting that pro forma and creating a situation where we're no longer consistent with fair market value from healthcare's industry's definition of fair market value. And then furthermore, need to be mindful of strategic value or investment value. Sometimes we're having clients request that we add additional expenses because that client's cost structure may be much more, and we'll certainly look at that more for informational purposes, but our conclusion is no longer fair market value. We're not looking at a hypothetical willing and able buyer and seller, and we're imposing a different cost structure on the business. Premise of value. This is an area where we're regularly running into issues because there may already be a joint venture in place between a hospital or health system and a physician group. I can think of a couple of different occasions where maybe a hospital or health system is working with an independent orthopedic group, and they may have a joint venture surgery center. That joint venture surgery center sits within real estate owned by the physicians, and they're coming up near the end of the lease, and the physicians want maybe a sweetheart deal on becoming a majority owner in this joint venture, and they're threatening to not renew the lease and to really shut down the ASC operations if they're not provided with a great purchase, and they're claiming liquidation value and need to consider just the asset approach. That's one where we really need to dig into the premise of value and understand, is that threat credible? Well, probably not. It's probably something we need to be very mindful of and get healthcare counsel involved right away. But furthermore, what's the appropriate valuation analysis if there is a liquidation, orderly liquidation? Doesn't mean we're just automatically turning to an asset approach. We can always consider an income approach where we're just looking at a discrete period, and the terminal value, instead of looking at the business into perpetuity, is focused on liquidating the tangible assets associated with the business and winding down the working capital. Misapplied theory. This is really something that that we'll see in healthcare valuation, but something that generalists see across many different types of valuations in many different industries, but really being mindful of folks getting so focused on the healthcare side that maybe their valuation theory and knowledge is lacking. Certainly have seen cases where there are folks who have come out of operating in a healthcare space and try to become a valuation consultant or a valuation expert, and they're great at doing needs assessments and really dissecting the subject business, but they are then misapplying valuation theory. It could be a situation where they're mismatching the economic stream to discount and the discount rate, a very common one that I'm sure many folks participating in this webinar have encountered. Or it could be something more complex in which there's a number of different methodologies that are being misapplied and consideration of approaches that shouldn't be considered. So we really need to be mindful of misapplied theory as a pitfall. And then non-valuation professionals getting involved regularly. Fred and myself are dealing with advisors who have been hired by an ASC or hired by a physician group. And these advisors may have a lot of healthcare knowledge, or they may not have very much healthcare knowledge, and they're setting lofty expectations that are difficult to change. They're setting these unrealistic lofty expectations, and especially with physicians, convincing the physician that the surgery center needs to transact at a 10 multiple, and that's what every surgery center is transacting at in the marketplace. That's great. That's an opinion. It may not be applicable to the subject surgery center due to a number of different reasons or factors. But certainly dealing with non-valuation professionals setting unrealistic expectations. On the income approach, focused on revenue projections, there's a lot of detail to get into for healthcare-focused valuators. We're expected to be experts around many different business types that we're valuing. Really need to know the ins and outs of how those businesses operate. What are the general supply and demand considerations that need to be taken into account at the onset of looking and evaluating a projection, if one is provided, or helping to develop that projection to be able to use within an income approach. And that's one additional challenge, is sometimes our clients are not sophisticated enough, or the targets of our clients are not sophisticated enough to develop a pro forma to provide us to use within an income approach. So we are tasked with going through an analysis of the historical financial performance of the business, as well as what the future financial performance could be, go through a number of different steps to assess what maybe some of the strengths and weaknesses of the business are, what sort of threats are existent within the marketplace, and start to dive into many of these items that are bulleted here. And I'll go through and provide some examples associated with each one. So general supply and demand considerations, really considering the market that the business operates within. Many healthcare, at least on the healthcare services side, unless it's a network of businesses, we'll just assume it's a single location business. It's the local market that is most important to consider. What is the primary market? What is the secondary market? What do the tertiary markets look like? How far of a net does this business cast and draw patients from the surrounding areas? In certain metropolitan areas, it can be a very narrow net. In certain rural areas or micropolitan statistical areas, it can be a very wide net. And then there's certainly cases where the business or the physician is specialized to a degree that that net's even casted very wide across the metropolitan area or even across the United States as a whole. So really understanding some of the general supply and demand considerations are important. Getting into the demographics and socioeconomics associated with those primary and tertiary markets, understanding whether a cash pay plastic surgery practice has enough patients to draw from in a particular micropolitan area. Are they really expected to be able to grow from $2 million in revenue to $10 million in revenue? Does it really meet the kind of the socioeconomics of that area, considering some of those different factors in line? I dealt with a recent valuation assignment where there was all of this growth projected by an advisor to a surgery center, and this surgery center was in a micropolitan statistical area that comes up as an area that's lost the most amount of population over the last 10 years and is forecasted to lose a substantial amount of population over the next 10 years. And the question really became, do we really think all of this growth is reasonable based on a declining population combined with the socioeconomic characteristics of this particular area? So really digging into those facts and understanding. There's lots of data available on the internet to be able to dive into some of those specific types of analyses. Newly introduced regulations and bills. I'm sure everybody on this phone is familiar with the Affordable Care Act, which changed the healthcare industry substantially, changed many ways. Reimbursement and future reimbursement is going to be structured. But there's other bills and acts on an annual basis that are passed, different American Taxpayer Relief Acts that try to, and we'll put balance in quote, balance the budget of our government. And in there are typically a number of different healthcare spending aspects embedded in the bills. So understanding that a bill was introduced and signed in 2014 and the effects don't kick in until 2016, we can't lose sight of that. And there's been a couple where a change in utilization assumptions of certain pieces of medical equipment in turn changes the associated reimbursement. Reimbursement goes down 20 to 30% for certain imaging modalities. And one has to be mindful of valuing a practice that has in-office ancillaries or an IDTF or another service line that has these imaging modalities. Has to be mindful, are we taking this 20 to 30% cut in Medicare reimbursement into account? We note that 50% of the payer mix is Medicare. It's likely that commercial will follow suit to a certain degree over time. What is the change in reimbursement over time, and how is that business going to survive? What sort of cost structure adjustments need to be made?
Nick, yeah, when was it, 2009, where in-office ancillary reimbursement for cardiology went down significantly, and as a result, we saw a lot more cardiologists willing to sell their practice. I think if you're getting called by physicians of the same specialty, all of a sudden you could probably bank on the fact that there might be a reimbursement change coming down the pike.
Really good comment, Fred. Should really look at these bills and different regulations that are being signed and try to understand how that's going to impact evaluators' practice in terms of what sort of transaction volume they may see, and there are certainly waves, and it's many times dictated by what's changing in reimbursement and some of the different struggles that a particular practice or other outpatient business or hospital may be facing in the coming years. Comparing revenue projections to industry benchmarks seems simple. I know I've worked as a generalist in my prior life, and I've valued all sorts of businesses, from gas stations to swine farms to Tier 2 automotive companies. And it's important to understand what are industry production benchmarks. For Tier 2 automotive companies, understanding what platforms are those components being sold into, what's the sales cycle look like, what's currently being developed, what sort of contracts does that business have with some of the auto manufacturers. It's a little bit more complicated in healthcare because there's so many different areas to benchmark and consider. It could be simply the production associated with physicians. Are they near the 90th percentile? Can they really expand much beyond the 90th percentile in terms of production, based on where they're at in their career, based on the number of worked hours, based on trends associated with changes in reimbursement? There's coding benchmarks to look at. We're regularly, as I indicated earlier, on the kind of the front lines of diligence, and we will look at evaluation and management, coding and benchmarks, and understanding how frequently is this physician coding a patient visit as a level 1 versus a level 5. Level 1 is less acute than level 5. Those sorts of components are important, and it's important to understand how that could impact projected revenue and what is a reasonable level of projected revenue. Capacity constraints. So mentioned worked hours from a services side can certainly be a capacity constraint, and the number of patient visits or surgeries that a physician can reasonably handle throughout a year. Other considerations are OR time. So a surgery center that has 2 operating rooms, how many, it's open 5 days a week, maybe 250 business days a year, can quickly calculate how many OR hours there are, depending on the types of cases being completed at this ASC, can take a look at what's a reasonable benchmark in terms of OR utilization. Is this particular surgery center near 90% utilized? And what are the related assumptions we need to take into account within a projection? Looking at a orthopedic-driven surgery center and they're averaging about 2 hours per orthopedic case, how many improvements can they truly make on that, and they're fully utilizing their OR time without substantial changes in other aspects of the business? And we'll talk a little bit about that from an expense standpoint on the next slide. And then inability to make certain market participant adjustments. I indicated earlier we've encountered pitfalls where non-healthcare evaluators come in, and maybe they're coming from more of the fair value world, and you hear about market participant adjustment after market participant adjustment. They come in and benchmark reimbursement, and there may be a reasonable adjustment to consider. Maybe there's some issue with revenue cycle management, and they're having a lot of denied claims that they're not collecting on, and they don't have the proper follow-up. So maybe there is a reasonable adjustment to make, but we need to view that adjustment in terms of what can this business accomplish without the help of a buyer. We can't look at, well, this buyer has much better contracts with, say, Blue Cross Blue Shield, or we're changing this from a freestanding facility to a hospital outpatient department, and there's going to be a pickup in reimbursement. Those are some of the adjustments we have to be mindful of and not take into consideration. And when we truly start to look at that buyer's rate of reimbursement in that example, we're switching over to investment value. Considering expense projections within an income approach, really looking at what sort of costs are reasonable for this business over time. And I have an illustrative graph that I'm sure folks have experienced. The prior slide had a graph of hockey stick revenue. I'm sure no one's ever encountered that before. And then costs on some sort of normalized basis decreasing substantially. Is that really reasonable for the marketplace? What are we seeing in our own practices, as well as in terms of surveys and other studies being conducted that analyzes physician comp year to year? What sort of increases are being observed and are reasonable? Or is something changing drastically with this business? Are they changing their structure to where maybe cost per FTE physician or FTE provider could change because non-physician providers or mid-level providers are being entered into the equation? So physician-related costs is typically an area to be mindful of, and also not decoupling multiple opinions. There could be a transaction in which I'm requested to value not only the business but also the compensation arrangement. Maybe I pull Fred in to value the compensation arrangement for the services post-transaction. We can't decouple those two opinions, and I can't project some business with some high level of profitability when in fact that profitability is just going to be paid out through some sort of change in post-acquisition compensation. So really considering those aspects of the transaction and considering both opinions in conjunction with one another and the total economics of the entire transaction. Other areas where we see different pitfalls, leases and associated maintenance expense. It's not uncommon to be dealing with modified cash basis financial statements, and we're not privy to having accrual financials. So understanding if there's, we'll call them free periods in quotes, where maybe lease payments aren't being made, but it's not brought to our attention that there's a new lease, or we weren't provided with a lease agreement to be able to look at the details. Also, there's sometimes a free period, say the first year, where maybe maintenance is provided for free, again in quotes, and then past that there's a fairly large annual expense to pay for annual maintenance on some piece of radiology equipment. So again, keeping those aspects in mind and not missing some of the details and some of the fluctuations that can occur in expenses, and especially when dealing with modified cash basis financials instead of the accrual financials that we'd all prefer to work with. Depreciation and associated capital expenditures. Some businesses are very capital intensive. I've mentioned imaging centers a few times. Understanding the life of the equipment, the depreciable life and the useful life may be very different, but not assuming that the business can operate into perpetuity with the same existing equipment, and trying to account for the fact that there may be a multi-million-dollar piece of equipment that needs to be replaced. Understanding the associated depreciation. We've been getting involved in valuations of proton therapy centers recently. It's not uncommon to see those proton therapy centers have equipment valued anywhere from 50 to 100 million, and then real estate valued on top of that with all of the leaseholds at another 75 to 150 million. So again, keeping all of those aspects in mind and not missing either the depreciation or the associated capital expenditures. On the medical supplies side, really considering not only changes in volume, but also changes in prices of supplies. So really the volume plus the price inflation. We'll see some generalists try to value a business, and they may hold medical supplies constant as a percentage of revenue because they're considering it a variable expense. That may not be adequate. I may need to consider what the inflation of some of the main supplies have been over time, and how that could change the projection. A flat percentage of revenue may not always accomplish that. In prior slides, we've had a number of different examples where we're mentioning occupancy. It's not uncommon to see physician-led organizations also have related entities that are real estate holding companies, and there may be related party leases. Some of these could be not the best deals that they've entered into. Maybe there's too much space, there's not enough space. Maybe because they don't care if the money goes in their left pocket or the right pocket. Maybe the arrangement's structured so the real estate is earning above market rents because they want to push a lot of money out of a C corporation into a pass-through entity. There's a number of different things to consider here and how multiple opinions can come into play when providing fair market value and commercial reasonableness opinions to a client that's looking to purchase a business. Same goes for management services. There can be related entities that are providing management services, sometimes for free, sometimes or for substantially below market, or sometimes for substantially above market for the same reasons. Maybe there's a situation in which there's a reason to push more funds over into a management company. I'm not referring to the friendly PC arrangements that we see in private equity-led deals, but again, thinking of really all of these related fair market value opinions that need to be considered in context of a transaction and the associated expense projections used in an income approach. And then kind of the last slide on the income approach with respect to business valuation, considering rate of return and long-term growth assumptions. Many times there's a limit of truly comparable pure play public companies to be able to compare to the subject business one is valuing in the healthcare space. So have to consider whether looking at an indice or a group of diverse companies that operate in the healthcare space is reasonable for developing an estimate of beta, or whether instead of a modified capital asset pricing model, one is to use a build-up method, not consider an industry risk premium, and instead try to account for some of those industry-specific items within the assessment of a company-specific risk premium. Really doing an in-depth analysis of the company-specific risk premium is important as well. There's a lot of different risks associated with businesses in healthcare. It's nice in that demand is somewhat insulated, but healthcare is always at risk of changes in the political climate and changes in regulation and things of that nature. So there can be a lot of risk associated with an income approach and the ability to achieve the projected cash flows within an income approach. On the long-term growth rate, trying to understand changes in reimbursement, changes in consumption of healthcare on a go-forward basis, as well as just changes in GDP of the country are important. Regularly see appraisals where non-healthcare evaluators are simply thinking of what are the changes in GDP, and I'm going to use that as a long-term growth rate. Well, how does that compare to healthcare expenditures? How does that compare to the local economy if this business is really subject to one or two or three small metropolitan areas? So really, again, thinking through the assessment of long-term growth rate and not going on autopilot. And that's certainly a pitfall that we see many appraisers encounter. On the market approach, a lot of the same issues that were mentioned earlier with respect to service arrangements, but here some of the additional issues that are business valuation specific. Confusion and misapplication of valuation multiples mentioned earlier, where business advisors may be explaining a standard multiple that's applied for ambulatory surgery centers, or what is the rule of thumb. It's easy for folks to misconstrue that multiple, not to realize that there's really a range around that rule of thumb, and it's going to be facts and circumstances specific. It's really associated with the achievability of cash flows on a go-forward basis for the business, as well as the risk associated with the achievability of those cash flows. In terms of specific...
You mean, Nick,
go ahead.
I should tell my clients they they can't pay the upper end of that range?
Yeah, they can't always pay the upper end of the rule of thumb range. Sometimes there are surgery centers that aren't worth 10 times EBITDA. Sometimes they're only going to be worth 3 to 4 times EBITDA for specific reasons. You know, the heaviest referring physicians have retired, left the marketplace. There's a surgery center that just opened up next door. There's always facts and circumstances that need to be analyzed and considered. Comparable transaction method, again, available of truly comparable transactions in addition to understanding the structure and really the participants of the transaction. As an example, with physician practices and related ancillary companies, say ambulatory surgery centers, private equity has been heavily involved for the last few years and is only becoming more involved as there's a lot of money to put to work, and they've identified healthcare as that space. The physician practice management industry is strong right now for certain specialties. We're seeing a lot of transactions where there's a transaction and it's being set up as a friendly PC because there's a corporate buyer involved, and they're looking at a platform company and spreading this, making additional acquisitions around the country in select markets. It could be ophthalmology related, or it could be some other specialty. But really understanding how that transaction may be reported in a friendly PC structure versus maybe a more traditional transaction where a hospital is outright purchasing a physician practice and a related ambulatory surgery center. On the guideline public company method, really not forgetting the differences in level of value. You have a marketable business, and you can typically turn those shares into cash within a few days versus having to sell a privately held business, and it may be taking months or years to turn that investment into cash. And then understanding historic versus prospective financial results. Hopefully many folks on the phone have access to Capital IQ and other resources that compiles analyst estimates, and one can take a look at not only historical multiples but also multiples of future earnings. As I indicated earlier, if you have a business that's subject to substantial decreases in reimbursement, it's important to understand how the market has priced that in, and being able to have access to analyst estimates or consensus estimates can be helpful in looking at the public equity markets. And then lastly, the asset approach, a few pitfalls. I mentioned modified cash versus accrual accounting earlier as a pitfall for other approaches. They can be a pitfall on the asset approach too. It's surprising at the number of appraisers I see go on autopilot and forget to assess whether there's off-balance sheet assets and liabilities to consider, not only for accrual accounting, but certainly for modified cash. It needs to be considered, whether it's working capital assets and liabilities, or whether they're truly accounting for all of their tangible assets and capitalizing those tangible assets. Those sorts of things really need to be taken into account. Capital book value is not a proxy for fair market value, especially with radiology equipment. Depreciable lives and useful lives can vary very much. There can also be obsolescence due to changes in technology that need to be taken into account. So again, book value is not a proxy for fair market value. And then real estate, we've mentioned below market leases with related parties. When valuing real estate and repricing real estate at fair market value, make sure you're working with a qualified real estate appraiser that has the ability to assess what market rents are and consider the property under multiple approaches, considering an income approach and a market approach, possibly a cost approach as well to value that real estate. And then lastly, intangible assets. Really when and how to account for these intangible assets is an important area. Many healthcare evaluators disagree on how to how to account for intangible assets and when to account for intangible assets. My personal view is that intangible assets can exist within a healthcare business absent an income approach to value the business. Certainly certificate of needs has demonstrated that they have value. We can even look at other approaches such as a market approach where certificate of needs are transferred and money is conveyed for that transfer. Again, so looking at those assets and considering some of the pitfalls associated with whether to include or not to include is an area of much debate within healthcare valuation.